Hello, my name is Richard Dukey, and I'm a financial services officer with GreenStone Farm Credit Services. I work out of our Monroe branch in Southeast Michigan. Today, I'm going to walk you through a little bit on understanding your balance sheet. So we'll start off with what is a balance sheet. So a balance sheet describes your financial position of an entity at a specific point in time. Most financial institutions would argue that a balance sheet is a cornerstone financial statement. Some would even argue with you that it is the most important of all financial statements. It can give you indicators of working capital, net worth, and available collateral. So more of you may be familiar with an income statement, such as a tax return. So this is a little bit of a breakdown of the difference between the two. So a balance sheet is a snapshot in time, as mentioned in the previous slide, that organizes assets and liabilities to establish an equity position. The income statement organizes revenue and expenses to determine a net income number. So balance sheet's looking at equity, income statement is looking at net income. There's multiple types of balance sheets. First is the cost basis balance sheet. So this starts with assets valued at their original costs, and then you less depreciation and add back in any money spent for improvements over the years. The benefit to this balance sheet is it does not allow for values to increase or decrease due to inflation. So the market basis balance sheet is the most commonly used balance sheet in ag, also the most commonly used here at GreenStone. It values assets based off the current market. So assets may also increase or decrease based off of how the market is reacting. So these can be to various conditions in the marketplace, or as well as the condition of the assets. Working condition can play a big factor, and other economic factors that can cause a swing in asset values. A little bit more detailed dive on the cost basis. So four main purposes here. It identifies historic profitability and retention or loss of contributed capital, identifies the amount of debt and repayment structure, establishes the cost of the asset, and can be helpful in identifying the cost of the asset during certain phases of estate planning. A deeper dive on market basis. So details the market value of the asset, identifies an implied value of the operation, identifies the amount of debt and repayment structure as it relates to the market value of the asset, and it can be rather volatile given the rapidly changing economic conditions. So the balance sheet in a little bit more detail here. So balance sheet is derived of two main parts, first being assets, second being liabilities. Typically assets are listed along the left-hand side of the balance sheet statement, and liabilities along the right-hand side. So you can further break down both of those categories into current and non-current, both assets and liabilities. And we'll get into a little bit deeper dive as to what that means here in the next couple of slides. And then a major financial metric that you can pull from the front page of a balance sheet is the borrower's or potential individual's equity. So this would be total assets minus total liabilities. So get into that a little bit more as well here in the next few slides. So assets, we'll start with the current asset section. So assets, these are assets that are cash or cash equivalent, typically are converted to or can be converted to cash in the normal operating cycle. So for general reference, typically 12 months is considered the normal operating cycle of most operations, especially cash crop operations. So an example, it would be things such as cash, checking savings accounts, accounts receivable, livestock held for sale, crop and feed inventories, growing crop, prepaid expenses, crop inventories, etc. So this is one half of the financials that are needed to help identify an operation's working capital position. Assets again, so these would be the non-current assets. These are assets that basically weren't mentioned in the previous slide. So we think of things that are typically on the farm for more than a 12-month period of time. So these are typically not converted to cash or used up over the course of a normal operating cycle. This would be like breeding livestock, machinery equipment, buildings, capital improvements, real estate, and other investments and retirement accounts. Jump down the right-hand side of the balance sheet now. So these would be your liabilities. So liabilities broken down again into current liabilities. So look at these as obligations that are either owed at the timing of the balance sheet or are due within the next operating cycle. So once again, referencing that 12-month window from the time the balance sheet is completed. So these would be things such as accounts payable. Those could be notes that you have out on elevators, or seed spray bills, stuff like that. Short-term operating loans, your revolving lines of credit that are due in the next year, your current personal term debt, current interest on your loans, and any other debts that would need to be satisfied within that 12-month window. So then this is the other half of your working capital calculation to help identify your working capital position. Non-current liabilities, these are generally due beyond the 1-year window, similar to the non-current assets, right? So now we're thinking out more than 1 year. These are the non-current portions of notes payable. So if you have a note payable that not all of it's due in 12 months, and then your non-current portion of real estate debt. So typically this is your principal balance type stuff. So from there, so let's say you want to get your own balance sheet started. Where do you start? So these are the 4 main things that come to mind when I'm looking to help a customer start a balance sheet. And we'll deep dive on each of these here over the next few slides. So first of all, and maybe most importantly, is who's the balance sheet for? So are you doing this on a personal level? Are you doing this for a business entity, either land holding or operating? Or is this a combination? So maybe you individually own some assets and your farm operation has also owned some assets, but for simplicity's sake, you only fill out one balance sheet, right? So that would be your combination balance sheet there. Then as referenced in some earlier slides there, the balance sheet date is ultra important as we are looking at this as a snapshot. We have various financial positions throughout the year. So if you think of your farm operation in the spring, maybe you're loaded up on prepays, got a little bit of grain left, waiting to get everything planted, right? Throughout the summer months, maybe you shift all of those assets into growing crop, and then toward year end again, you have no growing crop, no prepays, and then you're sitting on grain inventories or accounts receivable. So it's important to note what date that you're compiling that balance sheet so that you're getting an accurate reflection of that time of year to coincide with where your operating cycle would be. So there are many different templates and styles of balance sheets. So this is kind of, what are you putting your balance sheet in? Are you using some software like QuickBooks or Excel? There's various online forms if you're just Google searching, balance sheets. MSU and other ag institutions or ag colleges also have some forms that they can provide online. Or using one maybe that your bank uses, like you're here at GreenStone. If you give us a call, we can email you over a blank one, and you can use that one to fill out your stuff. So, and then you also have to pick out your method. So are you going to use that cost basis or that market basis? So here, I'm going to go through an example of how to fill out a balance sheet based off of some customer numbers. So typically we'll see guys bring in, a notebook paper and they'll jot down, what they think they have, that they own and they owe. And then we kind of help them through the process of just transferring things over. So I'm just going to give you a brief look at what that process kind of looks like here. So on the balance sheet that we're working on here, I'm just going to provide snapshots of it. So kind of fit it all on one screen, make it nice and easy to read. But typically this would all be a 1 or 2 page balance sheet here with the corresponding schedules. So we'll start with Joe Farmer here. He brought in a nice notebook paper of everything that he owns and he owes. And then me and him are going to go together and we're going to fill this out. So first off, he starts with putting his name on the top of his notebook paper. As mentioned previously, we want to know who the balance sheet's for. So it's for Joe Farmer as an individual. Then we'll flow that balance sheet date in. So 12/31/2019. He's matching his balance sheet with his income statement date, which is a good thing to do to help those two reconcile. So year-end 19 balance sheet. We'll start with the current asset sections of his balance sheet. So he's got $5,000 in cash. So we'll throw that into the checking area there. He's got $10,000 he's waiting on whole pay grain. That goes in your accounts receivable. And he's got some corn, so it's 5,000 bushel, uses a general market value at that point in time. And then you do your calculation and bring it over there. He's got some growing crops. So it looks like he's got 50 acres of wheat out there, whatever he's got into the wheat at that period of time. And then he's got some prepay. So he's got $10,000 at the co-op, and then he's got $7,500 in seed there with John Deere. So one of the most important things is to always total each of these schedules to help keep track of the current or the total current asset section. So here we add them all up. We get $56,750. So next we do the coinciding current liabilities. So he's got that seed, that John Deere seed, as previously mentioned, is on the 2020 John Deere seed plan, right? So not uncommon to see that type of stuff. So that's a $7,500 payable that's due before the end of the year. He carries a small line of credit with GreenStone, so he owes $10,000 to us. And then he also has his current portion of term debt calculated out. So this is basically his principal portion of his next loan payment due in the next 12 months. So we fill that in there. Maybe current portion of term debt is a number that you don't know off the top of your head or unfamiliar with calculating with. You can either look a little deeper into that online or contact your lender or your financial advisor, and they'll be happy to come up with that number. So next we'll bump down to intermediate assets. So here he's got his vehicles valued at $40,000. And then he listed here, for simplicity's sake, all of his machinery equipment at $300,000. So typically it is good to keep an equipment list with year, make, model, estimated value all filled out. But like I said, for simplicity's sake in time here, we're just going to put a blanket statement. But if you are doing your own balance sheet at home, I would recommend to break everything down and do that year, make, model value for each piece of equipment that you have. Then he's got some retirement accounts here at $50,000. So then one of the most important steps, he goes back in and he totals it all up. Then all offsetting liabilities for those intermediate assets. He's got one tractor loan. He goes ahead and fills that in there. I think the most important thing is maybe note the lender that you have it with, your interest rate, maybe put your payment down, what your annual payment is, and then definitely the balance still owed. So for long-term assets, so this is where you have real estate typically. So here he's got 120 acres. He puts a value of $4,000 per acre in there. So then you calculate that out, and then he's got his home farm. For simplicity's sake, he rolled his house, buildings, and his home 40 all into one and just did it as a total value there. So you see that $400,000. Then you got your combined total of $880. So I always think if you're doing it for yourself, maybe keep your balance sheet as simple as you'd like. You can add detail to it later. If you're providing an initial balance sheet to a lender, maybe make it kind of simple on the front end. Don't try to confuse yourself and do a deep dive with it. If they need more, they can help you get into that number and that additional information that they would need. So these are offsetting long-term liabilities. So here you see on some of those acres that he owns, he's got a GreenStone loan for $250,000. So it's important to note, once again, the lender, your interest rate, your annual payment, if you know that offhand, and most importantly, your principal balance. So you go ahead and flow that through as well. So here we end up with our final numbers, right? So we totaled up our current assets, our intermediate assets, and our long-term assets. That gets us our total asset number. And we did the same for the corresponding liabilities. So current liabilities, intermediate liabilities, and long-term liabilities. And then we subtract the total assets from the total liabilities, and we get our net worth number. So here, Joe Farmer, very strong net worth. So from there, it's also important to sign and date your balance sheet to verify that the information you provided to a lender is correct. So kind of a real quick overview. Like I said, typically this would be a one pager that I kind of snipped up and I took different pictures and pieces from. But many forms like this available. This is the one that we most commonly use here for our simple, less complex transactions. There's also a software that we'll use if things get a little bit more in depth. But like I said, try to keep it simple on the front end. Just have a good basis of your numbers, know where things are. And then as your operation either develops and get more complex, maybe start looking into a QuickBooks or a tax and accounting service such as the ones we offer here. or just working with your lender and maybe helping them compile your balance sheet on an annual basis. So with that being said, that's kind of the general overview of, understanding your balance sheet and pulling one together. I call that your 100 level course. Of course, you can always get a lot deeper and dive into, where these metrics are coming from and spreading these numbers different ways. But those are kind of one-off conversations if you have any additional questions. So I will provide my contact information here. Feel free to reach out to me or shoot me an email if you have any questions as to how to fill out your balance sheet, or if you want a blank template, or just want to chat about it in general. So also to direct you over to our website there. Like I said, I work out of the Monroe branch. So if you're looking for a branch a little closer to where you are, that information will be available for you on our GreenStone website. So thank you and have a good day.